Joining us now is Douglas Elliott, a former investment banker at J.P. Morgan. He is now a fellow at the Brookings Institution. Doug, thanks for coming on the show. Let me first ask you about if it's a good idea to try and cut down banker bonuses. I mean, you can understand why Washington would want to do it. There's a lot of outrage in the public. Obviously, they want to try and recover some of the money we spent to bail these guys out. But could it be the wrong move?
I think it probably would be. It would depend a lot on how exactly you did it, but there are an awful lot of ways for that to go wrong. I think if we're mad about the deal the banks got, if we think they got too good a deal, we should simply put a tax or a fee. I'd suggest relatively moderate, but just get the money back from the banks. Trying to do it through the compensation route, well, let me tell you one of the absurdities of it. If we put a tax on bonuses and persuade, therefore, the banks to pay less in the way of bonuses, all that means is the bank shareholders get the money. I don't think the bank shareholders are any more morally deserving than the bank managers are. If we're mad for the taxpayers, let's help the taxpayers.
I wonder about the windfall tax. I mean, there are drawbacks to that as well. You say it's the route that you would choose, but what are the drawbacks? Let's go with them.
Well, I wouldn't do so much what somebody would think would call a windfall profits tax. That would usually be more related to the level of profits or something else. I think I would do something more like charge, say, 10 basis points for a few years on the amount of assets, or something like that, almost like an insurance premium, but we're catching up after the fact. If you try to do it off of profits, there are all sorts of ways that you can have an unfairness or an inefficiency. I mean, would you go after the banks that had done best? Well, they're the ones who needed the help the least. Would you go after the ones that the taxpayers helped the most? Well, they're in trouble still, many of them, or at least weak. We don't necessarily want to hit them with significant taxes, plus some of them we own 40%. It's very hard to do this unless you just go for kind of a moderate, simple approach.
So, Doug, what's likely in your view in terms of some kind of tax on the financials? As you say, it's kind of complicated to kind of sift through and who gets what. So what do you think is likely?
I think there probably will be something along the broad outlines that I was giving. That is, I think there will be some relatively low percentage tax on assets, or maybe a little higher percentage tax on profits. It'll be spread out over a number of years. It may not start for a couple of years to give the banks some time to get back on their feet. I think there will be something because the public's too mad not to do something. On the other hand, most of the things that would be emotionally satisfying would actually hurt us more than help us.
What do you think about the idea that you could use some kind of tax or a fee to restrain or penalize too-big-to-fail institutions? We had John Thain on this morning. He said the top 5 banks in this country are too big to fail, and he would go that route.
I think it does make sense for there to be an extra insurance premium, basically, as well as tougher capital rules on the biggest banks, the ones we know we'd have to rescue. They already get a benefit from the implicit guarantee that's been looking pretty explicit lately. They've got economies of scale where they do have some advantages. They could afford this. But we want to give them some incentive not to be quite so big. So the combination of the incentive and the fact that we're at risk to them in a way we aren't with the smaller banks, I think does justify some sort of fee.
All right, we're going to have to leave it there. Hey, Doug, thanks so much for your time today. Douglas Elliott over at the Brookings Institution.